Hello, good evening, friends. Uh, I start my today's session. That is a discussion on section 14A. And in fact, this section 14A has to be necessarily read with Rule 8D of the income tax rule. So, section 14 capital A says that lays down the principle when the expenditure incurred in relation to income, which is not includable in total income, will not be allowed to be claimed as expenditure. Now, let us read it one subsection at a time and find out the intent and purpose of each of the subsections. So, section 14A, subsection 1 says that notwithstanding anything to the contrary contained in the Act, for the purposes of computing the total income under this chapter, no deduction shall be allowed in respect of the expenditure incurred by the SSC in relation to income which does not form part of the total income under this Act. So what it says is that the expenditure earned incurred in relation to the income which does not form part of the total income will not be allowed. So if the income gets included in the total income for the purpose of computation, and then it is deducted. For example, income in the nature of section 10A, capital A, 10 capital B, 10 capital C, or say deductions in the nature of allowable under schedule 6A, then those kind of deductions which are in the nature of deductions from the total income, there is no disallowance of expenditure earned in relation to those kind of even if the entire income in totality is deducted. For example, export profit. If the exports profit are totally deducted, even then the expenditure earned in relation to export profit will not be disallowed. It is only those kind of income which is totally exempted, which does not even form part of the total income. The expenditure in relation to that income is only to be disallowed. So, for example, the three income which immediately one can refer to, one is agricultural income, another is income in form of dividend, even though dividend with effect from 1/1/2021 has become taxable in the hand of the recipient. And prior to that, dividend was attracting dividend distribution tax and was exempt in the hand of the recipient of dividend. But till 2020, the dividend was not a taxable income. Then thirdly, one can say share of profit in a partnership firm, which goes to section 10 and does not form part of the total income also. So one has to find out those type of income which does not form part of the total income, and then expenditure incurred in relation to that income. And if there is any expenditure incurred in relation to that income, then it will not be allowed as a deduction. Now here I must draw an analogy from section 17 and rule 42 of the CGST, which also does not allow input tax credit in relation to those expenditure which are incurred in relation to exempt income. But there is a difference between rule 42 and rule 8D, and as I discussed, I will explain that difference. So subsection 1 says that expenditure incurred in relation to total income, which exempt income, which does not form a part of the total income, will be disallowed. Secondly, subsection 2 says that the assessing officer shall determine the expenditure in relation to the income which does not form part of the total income in accordance with such matter as may be prescribed. But the question of invoking comes only if the assessing officer, having regards to the accounts of the assessee, is not satisfied with the correctness of the claim of the assessee in respect of the expenditure in relation to which the expenditure has either been claimed or not claimed. So here I was discussing the difference between Rule 42 and section Rule 8D. Under Rule 42, the assessee himself has to proportionately claim input tax credit in accordance with the formula prescribed in Rule 8 in Rule 42. So the Act read with the rule itself prescribe the formula in accordance with which one is supposed to disallow the claim of the input tax credit. But that is not so in the case of Income Tax Act. Under Income Tax, under Section 14A, the assessee can maintain the books of accounts in the manner in which he deems fit. For example, he is maintaining separate books of account for exempt income and the taxable income. And there are no common expenditure. And even if there are common expenditure, the assessee adopts a reasonable method of apportioning expenditure between the taxable and in the non-taxable income or the exempt income. I will be using the word exempt income. Then the question of invocation of Rule 8D does not arise. So Rule 8D arises only if the assessing officer is not satisfied with the claim of the assessee as per the books of accounts maintained by the assessee, and the assessee is entitled to maintain its own method to either claim or not to claim the expenditure. So the assessee has been given the complete freedom to choose its method and methodology to either claim or not to claim an expenditure, whereas that is not so in the case of GST Act. In the GST, the input tax credit can only be claimed in accordance with the formula which is prescribed in Rule 42, 43, etc. So that is the difference between Income Tax Act and the GST. And now the question arises is that how the assessing officer will be satisfied or not satisfied. Now, if the assessing officer is not satisfied, then it is necessary that it should not be arbitrarily done. So, assessing officer, if he is not satisfied with the claim of the assessee, then he should call for the accounts and record of the assessee, and he should pass an order of his dissatisfaction and give cogent reason for the same. It cannot be that he can straight away adopt Rule 8D. He has to pass an order. It cannot be subjective satisfaction of the assessing officer. The, the, the satisfaction of the officer for invocation of Rule 8 capital D can only be recorded if he issues notice to the assessee, and after issuing notice, he calls for the accounts and records, and then after recording, he comes to the conclusion that the assessee's claim is not satisfied. And with this regard, I can refer to a judgment of the Honorable Bombay High Court in the case of Godrej and Boise Manufacturing Company Limited, reported in 234 CTR Volume 1. Now, again, subsection 3 says that subsection 2 which empowers the assessing officer to resort to Rule 8D. So it says that the subsection 2 will not apply in cases where the assessee claims that he has not incurred any expenditure in relation to the income which does not form part of the total income. So if there is a claim of the assessee that he has not incurred any expenditure whatsoever in relation to income which does not form part of the total income, then it will not apply. Now here I would like to discuss a scenario that suppose the assessee is having both the owned fund as well as the borrowed fund. And let us take a situation that he makes an investment. Presently, you see most of the disputes are surrounding dividend income. But let us here presume a situation where one has made an investment in the partnership firm. And he is having both the borrowed fund and the owned fund. So here the presumption would be that he has utilized his borrowed fund. So suppose he is having rupees 100 with him, which is a borrowed fund, and he is having rupees 100, which is his own fund. So the presumption would be that he has utilized his own fund for the purpose of making an investment. And therefore, the question of disallowance will not arise if somebody is having the owned fund. It will be a presumption that he has used his borrowed fund for the purpose of his other business ventures and not for the purpose of making investment. Because usually people invest money only if one is left with a residual money, excess money, or overflow. Nobody is going to make an investment just for the purpose, even if one requires the money for the purpose of his ordinary business venture. So that is presumption number one. Secondly, with effect from 2022, an explanation has been inserted which says that even if there is no income in a particular year, for example, let us take a scenario that one has invested in a company and in a particular year no dividend is declared. Or for example, one has invested in a partnership firm, but there is a loss. There is no income whatsoever in that year. So the question is, where can any disallowance can be made? Ordinarily, the jurisprudence was that if there is no income, then the question of disallowance does not arise. And Rule 8D or any disallowance cannot be done at all. Now that part has been explained, and explanation means that was always the intention of the lawmaker. And this explanation has been inserted with effect from 1/4/2022. And what it implies is that even if there is no income accrued or arisen or has been received during the previous year, it does not mean that there is no expenditure incurred in relation to the income which is not forming part of the total income. So there can be no such presumption. Now the question arises as to how one is going to determine if there is no income at all. So the determination will be on the basis of your, suppose one has borrowed money and is incurring interest expenditure, and in a particular year there is no income whatsoever. But in the previous year, that in borrowed money or borrowed fund was presumed to be towards to be taken towards exempt income, and interest was disallowed. So in the subsequent year also, even if there is no dividend income or there is a loss in the partnership firm, there will be a corresponding disallowance, even if there is no income whatsoever. So that is the purpose of insertion of this explanation. Now coming to Rule 8D. Now, Rule 8D does not have any formula for proportionate allowance or disallowance. There was a formula till 2016, but as on date, the formula says that if the assessing officer is not satisfied with the correctness of the claim of the expenditure made by the assessee, and the claim made by the assessee that no, or the claim made by the assessee that no expenditure has been incurred in relation to the exempt income, then he shall determine the expenditure in accordance with sub-rule 2. Now, sub-rule 2 says that it should be aggregate of the following. That means the amount of expenditure directly relating to income which does not form part of the total income. So the assessing officer has to find out that expenditure which is directly relatable to exempt income. So he need not find out that what is common expenditure, because there is no need to proportionately allow or disallow common expenditure. That assessee can do on his own, and if the assessing officer is satisfied with the method adopted by the assessee, then he can very well accept the formula of the assessee. But if he takes recourse to Rule 8D, then there is no concept of proportionate apportionment of expenditure between taxable income and exempt income. All that the assessing officer is to do is to determine the expenditure which is directly relatable to exempt income. And secondly, he will add that with 1% of the annual average of the monthly average of opening and closing balances of the value of investment, which does not form part of the total income. That means he has to determine the average investment. 1% of the average investment will be disallowed, and the expenditure incurred in relation to the total income will be disallowed. So summation of these two figures will be disallowed. There is no concept of proportionate allowance or disallowance of the expenditure. So this is what Rule 8D says. So compared to what it was prior to 2016, Rule 8D has been considerably simplified, even though it may cause hardship to an SEC on the ground that once you have already allowed that expenditure which has been incurred in relation to the exempt income, then what is the necessity of this disallowance of 1%? But the logic is that there is always some management expenditure or common expenditure which one may not be able to find out or determine. So it is better to adopt this 1% formula, and the government thinks that it is quite reasonable to disallow 1% of the average annual investment. Now here, with respect to the amount of the investment, if it is an investment in shares, then only the nominal value of the shares will be considered and not the investment plus the share premium. For example, suppose 110 rupees has been invested in the shares of a company, and but dividend is always declared only on the 10 rupees. That is the face value of the share, not on the premium amount. So if dividend cannot be declared on the premium amount, then investment with respect to the premium amount cannot be included for the purpose of determination of the average investment, for the purpose of computing this 1% of the average investment. So only the value of the nominal value of the share on which the dividend is declared will be considered for the computation of this disallowance of 1% expenditure of the average investment. Now, another aspect is that suppose one has made a strategic investment in order to acquire control of a company, and not with the purpose of dividend, whether disallowance under Rule 8D and Section 40A, 14 capital A can be made. So here there is a judgment of Honorable Supreme Court in the case of Max Op Investment Limited versus CIT, where the Honorable Supreme Court says that if there is a strategic investment with the purpose of acquiring the control of the company and not with the objective of dividend income, then even then, since the objective is to disallow the expenditure earned in relation to exempt income, so that dominant objective or the purpose of the investment cannot be looked into. Once dividend income is earned, then the disallowance has to be necessarily made. So friends, with this, I think I have discussed all the aspects of section 14 capital A read with rule 8D, whatever I felt is necessary to be discussed. If you have any question or any comment or anything one wants to disagree with anything which I have discussed, then you are very much welcome. Thank you very much. So I think nobody has any query with respect to today's discussion. So with this, I would like to conclude today's session. Thank you very much for joining, all of you. Thank you very much.